All right. So Chuck says, good day, Mike. Good day, Chuck. Good to see you here. I think you're still here, but he didn't have a follow-up question. Ashwin says, hi, Mike. Hi, Ashwin. How you doing? And Ashwin follows up. He says, can you have a look at MSTR? The January options have massive spreads. How can you trade a debit call spread? Which is one of the reasons, just on a whim, Ashwin, of why I typically don't look to trade in the money or bull call debit spreads as often that are below the current stock price that are in the money, because the wide bid-ask spreads make it harder to get filled. That's when I would typically do a bull put credit spread. The out-of-the-money puts usually have a lower bid-ask spread than the in-the-money calls. But let's take a look on Monster here. Now, I'm just going to, all right, we're going to look at the chain first for Monster. I think it's Monster. I hope it is. I hope I'm getting that right, Ashwin. And you said out to January. Okay. And yeah, we're looking at about $3 spreads here. Even if you're looking at the money Ashwin as well, sort of that longer term at sort of out of the money. In that case, so you're looking at 3 points, 420 here, $4.10 here. There's a big 5-point one here at the 160 strike. The out of the money's sort of a big move. I'm sorry, it's MicroStrategy, MSTR, not Monster, MSTR, MicroStrategy. Okay, but yeah, big bid-ask spreads here. I don't know what MicroStrategy does, but what I do know is I'm going to go to stock research. Okay, so the next expected earnings are at 126. Volatility is not bad, but the SIV is around 0.592. Yeah, and that's about right. So the volatility is still high at around 0.6. All right, so they're related to Bitcoin, Ashwin, as well. Okay, so that's what you would say. A big investment in Bitcoin. That's it, Ashwin. There's a lot of things going on there as well. Now, I'm wrong, of course, on my assumption because of this relation to the Bitcoin, I guess, Ashwin, and something might be on the horizon. You might want to do further research and analysis on why these are so big. Do they have something about a potential buyout? Are they planning on buying someone else? Just related to the volatility of Bitcoin, why this bid-ask spread is so high. What do I mean? I was wrong. Out of the money puts, I'd usually look for probability of 85%. I don't have the probability, do I? Okay, so let's just use this range here, the 140, 135. And I'm looking at a 450 and 440 bid-ask spread on the puts, almost equivalent to 410 and 420 on the calls. So this what is breaking my assumptions, Ashwin. The volatility is too high on this position to be guaranteed the midpoint for a good price. You could try it, of course. Might not be too bad to get it if there's a lot of activity on these positions. Let's clear out of the call and put chain for a moment. Let's just go to the call chain, Ashwin, so we can see more details that I have there, more columns. Got the delta. Yeah, there's not a lot of volume in an open interest on those in the money ones, or even the at the money ones is really where the activity is at, isn't it? 149 open interest, but there's not a lot of daily activity on these positions out to January, and that's might be what you're fighting as well, Ashwin. Okay. All right. So you say they have a $5 million investment and you want to buy a call spread. Okay. Well, I understand you want to buy it, but I can't change the market prices for you. None of these options further out of the money speculating wider or in the money, they're all the same. You've got a $2 bid-ask spread here at the 180. You've got $4 here at the 185, $4 here at the 175. A common approach to have, sort of a 50-50 win-loss ratio or 1-to-1 bid-ask spread, 1-to-1 risk-reward ratio, Ashwin, on an out-of-the-money bull call debit, probably be going to the 160 to the 170 with the stock at 167. And as you can see here, that'd be a debit of about $4.65 for a 10-point spread. That's even though it's what if you get midpoint, of course. If you don't get midpoint, let's say you go 22 and 13, yeah, you're at a 9-point debit for a 10-point spread. It's still that risk of you're not near the 1-to-1 risk-reward ratio you want. I'd say try to put on the midpoints, and if you get filled, you get filled. I'm really sorry. That's the best advice I give you. There's no trick right now that you can minimize the market bid-ask spread rather than doing a ratio. You mentioned, Ashwin, it will be a problem getting out. Look at the daily volume. Look at the open interest. I mentioned the 160, which might have been a terrible idea just as a general view. We'll look at that P&L in a moment. There's only an open interest of 9 on this position. One contract traded recently, and then the 170 is at least at 33. It's possible this is a double spread here, 42 and 76 with 149. Someone might be doing a ratio back spread here with the 155, 150 strike combined with the 165. It's really possible. But again, yeah, you'd have a problem getting out, especially at midpoint. Market makers going to try to, since there's not a lot of activity, there's not a lot of high open interest, there's not a lot of high volume, market makers going to push you to the worst price if you go to sell to close and the worst price if you try to buy to close. When you open the position to open, you might get closer to midpoint, but closing it, you might be in a severe trouble. I'm not saying you are. Volume, open interest, activity very well might increase by then, Ashwin, but that's going to be a tricky position to get filled at midpoint, I believe. And if you do get stuck with it not going your way, it might be very tricky to exit in a timely fashion due to the low volume, due to the low open interest. I said a 160, 170. Highly unlikely we'd get it, but we're going to try to go for midpoint. I'm going to let the tool here, our custom spread tool, just fill in the midpoint for us. As I mentioned, 465 midpoint for a 10-point spread. You're pretty much at that 1-to-1 ratio that you'd want. Let's go halfway now. Let's get not the wrong prices, but let's go halfway. What do I mean by that? So the midpoint was at 19 for this, but if I put in a bid to buy this 160 call at 1985, was it? Yeah, 1985. What the market maker may do with this low volume is the minute I enter that order with my broker to buy to open this at 1985, I might see the bid change to 1985 and the ask stay at 2220. Why? Because the market maker is going to try to push me higher. He's going to want that, or the electronic market maker is going to say, hey, if you're interested here, I'm just trying to get some fill points in between. I'm not giving you this at 1985. I want you closer to 21, right? I want you closer to 2110. So let's say we don't get the midpoint. Let's say we get the 3/4 point, okay, away from the ask. So we're at about 2110. And we'll do the same thing here. This is the option I'm selling. I put in a bid to sell it at 1510. Well, he leaves the bid at 13 and drops the ask to 1510. So now what happens? My sell price goes down to 1405. So right there now you see the problem with just that move, getting 3/4, the worst case scenario. 3/4 towards the bid, 3/4 towards the ask. You're going to have a debit of 705 on a 10-point spread. So you'll get $3 back. So that's not bad. It's a little bit less than a 2-to-1 ratio. Okay. But again, that's what you might see happen. This is what I see happen, by the way, with some of my married put positions when I'm buying that far out put that has a 4-point spread or a 5-point spread. I put in the midpoint and I see him move the bid to my mid because he's trying to get me closer to that ask price that they have listed. And if it's beyond the risk that I'm willing to take, I'll back off of it or look for another put. I won't trade that stock. But if it's still within under 7 or 8% risk in this case, Ashwin, I might take it. That's different than this one, of course, because you see how quickly it adds up. But let's just clear this up. Let's look at your profit and loss if we got filled at 3/4 the midpoint. A worst case scenario, I said 2110, I believe. And 1405, was it? Or was it 1410? We'll use 1405. I think that's what I said. Yeah, 705, still a 41% return, not bad at all. But again, you're at about a 2.5-to-1 risk reward ratio, not the 1-to-1 that you want if you're using an out of the money bull call debit. But again, that's okay. Now, if MSTR starts to fall and I scramble and I'm trying to get out of it, as you mentioned, because of those positions, because of the low volume, I may have a very hard time getting out of the position in a timely fashion as it moves against me to stop my particular risk or the loss that I'm taking. All right, so now we've got Darrell's got a couple questions. I haven't read them both yet, so I'm not sure if they are related to one another. Darrell says, can you detail strike selection criteria for a bear call spread? Okay, so, and then you said, broker requires buy, sell per option table, buy at 100, sell at blank. In other words, how do you arrive at the sell value? Risk graph conversion to option table value at that time sounds confusing. Okay, yeah, I'm not sure. Here's what I'm going to say, Darrell. All of you have heard me talk about how I do the bull put credit spreads, and that in general, The search criteria that I use, Darrell, is the Bull Put Weekly. I've tested that. I've been trading it, extensively testing it while trading it, but more extensive. I've done more tests than I have actual trades, but I have been trading this. Don't get me wrong. All right. So I look for a structure, and through testing, I found a structure that worked for me best. And essentially what it was is I'm looking for a strike difference of greater than 2 points. I want a probability of 85% or higher on stocks that are in a downturn, and I want to look for a minimum of 9%. Really, I'm trying to target more of a return of an average around 15% for the positions. Okay. Of course, I'm avoiding earnings between now and expiration in that case, Darrell. And so what I do when I look for a bear call credit spread, this is why I use PowerOptions. Honestly, it helps me save time. I don't build it personally on an option chain. And if you're looking at a particular, I think what you meant is you're saying you're looking at a stock, you want a bear call spread, you're looking at the out of the money 100 to buy. Well, which call do you sell? This is why I use the search tool. And of course, I don't have bear call credit. So let's go to other strategies. My apologies here. I take off long call for the time being. And I'm going to go to bear call credit, add that in, and save our configuration. Now, everyone has their own way of approaching it. But to me, through the testing, this is what I found. This is what worked for the bull puts. Believe it or not, it didn't work as well for the bear calls in 2018, where 6 of the 12 months were negative market performance and the market was down. The bear calls with this structure did worse than the bull puts did. And that's because during that time frame, those 6 times the markets were negative, 3 of those 6 times happened over a 4-day period. The bullish runs were longer, so you had 5 or 6 cycles of bull put credit spreads where you're successful, and only a 4 or 5-day period where the bear calls weren't needing to be managed half the time because the market was ramping back up after that quick decline. It was a very odd market condition in that case. But Darrell, what I'd look for essentially personally would be the same thing. I want an 85% probability on the short. What does that mean? That means that I'm looking for a probability that the stock would remain below the short call between now and expiration of 85% or more, or maybe a delta of 0.2 or less. I don't focus on buying the long option first in a bear call spread. I'm not sure if that's exactly what you meant, but you had said sort of, if I buy the long, what short do I do? My focus is on the short. I want to be a certain range out of the money for a monthly or a weekly spread. I want an 85% probability. I'm going to keep that strike difference at 2 if I'm doing a shorter term as well in that case. And I still want my return. So let's put that all together. And of course, what else do I need to do in this case, Darrell? I don't want any surprises because I know my credit spreads could experience a 100% loss if the stock suddenly goes up above both strike prices beyond my control or drops down below both strike prices beyond my control. So I'm not going to do any stock that has earnings between now and the expiration. Let's keep it a standard November in this case. I'm going to tell the system, hey, if I'm going to November 21 days out, I want at least a 45-cent net credit. I want at least a 9 or maybe 10% return. Yeah, I'm going to want to be at least maybe 5 or 6% out of the money or more if possible. I'm going to want an 85% probability that the stock's going to stay below my short call strike price. Just to get rid of anything that might have not traded in a while, we're going to put in a basic open interest option volume today. All right, so what did I do? I'm looking out to November, minimum net credit and return. Oh, yeah, my strike difference. I don't want to mess around with $1 strike differences. I don't want to mess around with 50-cent strike differences. I'm going to go 2 strikes or greater. You can even go 250 or greater. That's what I would suggest. Now, basic fundamentals, what am I going to do? I want a stock that's trading below its 20-day or 50-day moving average. I want a stock that's in a downtrend. Okay, so I'm going to use 50 a little bit longer. And I might even use a negative MACD. I want this to have a negative crossover of at least 2 days or 3 days maybe. Okay, and then for the fundamentals, excuse me, I don't want any earnings between now and expiration as well. I might even look for negative earnings per share growth, possibly as well, underperforming securities. Some basic stuff. But as far as the option goes, I'm focused more on the short. Okay, the short is my pivot. I want the short to be a certain range out of money. I want the short to have the probability. I'm not saying, oh, I'm going to buy an option at 100 and then look to combine it with a sell. No, I'm saying what is far enough out of the money for me to sell and then look at the option that gives me the credit, the option to buy, excuse me, Darrell, that gives me the credit I want and gives me the risk reward ratio I want as well. Let's see if we get anything. All right, Zoom, 570 to 575, a 5-point spread, midpoint price around 65 cents for a 14.9% return with an 86% probability. Not a recommendation or suggestion. Why is Zoom appearing so much? Because probably I didn't limit it to one result per security. But this is the one that's been below, has shown a negative, MACD crossover for at least 2 to 3 days. It's below its 20-day moving average, has the return I want, so does Fiverr and Shake Shack as well. So let me check the one result per security just to clean it up. That'll clean up the Zooms a little bit. Okay, so that's what I'm looking for. I'm not going to the chain and looking at Zoom and saying, okay, I think this is bearish. It's been dropping consistently. If I want to buy the 500 call, what call would I sell next? Well, obviously, I wouldn't do any of those because they don't have my probability. They don't have my range out of the money that I want. It would give me a much higher net credit if, for example, I did buy the 500 call and then sold the 490, but it didn't match my criteria, Darrell, for my trading plan. That's what I use PowerOptions for. I don't go to an option chain to build a spread. I use this to find the positions that match my specific criteria for the stock and the option. Saves me time of trying to build something in my head on a spread chain. I'm looking for the short option always first. Bull puts or bear calls, the short option, my pivot, because this is the one I need to focus on if the stock starts to recover. The long call is there to help me keep down the cost. To help me cap the risk of a naked call and to not eat into too much of my net credit, but it's a safety there. But I'm not using the long call as any type of trigger point, stop. Everything is based on the short. I focus on the short first, the range out of the money I want and I'm comfortable with, the probability of it being below that short call that I want, and now it also has to meet my net credit requirements and other stock filters as well. All right, so that's how I pick a bear call spread. That's what I'm going to look for if I'm doing a bear call spread. I'm not in bear call credit spreads now. As I told everyone last Friday, this cycle on 10/26 would have been my regular cycle to trade the weekly bull puts, and I'm taking a cycle off. Why? Because of the EAP, the big earnings that came out today, the election coming out on Tuesday, and we're still in the pandemic. However, just for fun, I am tracking, there it is. I am tracking the bull put credit spreads I would have traded that match the screen right now. That matched the screen on Monday afternoon on 10/26. It would have been this BLK spread at 577.50, 575 for bull put credit spread. Ring at 250, 250, and 247. 190 to 187.5 on SPLK, and then UNH. But UNH got hit real bad, didn't it? The stock's trading at, it closed up higher today. Oh, bummer. Why do I say bummer? It's still at a significant loss. Took in 108. It's a 2.5-point spread, so it's going to cost me a lot at midpoint to buy it back to liquidate the position. And this will relate to Wes's question, what's coming up after Ravi's, but we'll talk about that in a moment. When I looked at this at 345, it was at 301, and it was beautiful. It was the perfect setup for a pendulum adjustment, even though the stock had dropped today below that short put strike price and blown below my stop. Pendulum is not something I'd really consider doing now that it's above the short put strike price and right at my 1% stop rule. What's the 1% stop rule? Well, my short is 302.50. 1% of that strike price is $3. So if the stock was at 305.50, that was my trigger point. It was just below it. But at about 345, 350 today, this was down at 301. And it had, you saw the loss that was there on the portfolio for that bull put credit spread. It was the perfect example. And it looked like it would have been potentially wrong. It would have been wrong, that's right. But it was the perfect example of that time of what a pendulum adjustment should look like. If I had bought to close the 300 and sold to close my 300 long put and bought to open the 305, it would have given me a bear put debit spread, 305, 302.50 with a stock at 301 for a 12.2% gain. if my sentiment had changed and the stock had stayed below 302.50 instead of moving back up. But now it's back up. It's looking okay. It's just at a big loss right now because of volatility, and it had just come below that at that price. But I'm illustrating this, even though you didn't ask about bull put credit spreads, Darrell. I'm illustrating that because this is why I want to start off that certain range out of the money. This is why I want to start off focusing on the short put or the short call in a credit spread. Is it the range out of the money I want when I open it? Does it have the probability I want? Now the combination of the long, is that still giving me the net credit that I want to meet my trading plan and my trading goals? And that's how I use the search tool. So I'm not spending my time on a chain trying to look at all the different numbers and combinations. I'm going to let this smart computer do it itself. Do it for me with my criteria input into it, Darrell. That's what I'm looking to do. Okay, so that covers that topic there for the bear calls. Again, look for the probability below on the short call. Look for a spread that matches your goals for minimum return, whether you're looking at a 2 or 3 or a 4 point spread on the net credit, trying not to give up too much to it, Darrell. That's what you want to look for. That's what you can put in the search tool so it can find it for you rather than you doing it on a chain yourself. All right. Darrell had a follow-up comment. He says it's exclusive answer on the bear call spread, but for the time being, I have to build and select strike option table. No need to demo if we're out of time. Thank you for the beautiful answer. Yeah. I don't know which chain you're using, Darrell, but let me go back to the example I was using. Do you remember what I saw on the bear call? This is not what we were looking for, but let's use MSTR. Oh no, we were bullish on MSTR. Okay, let me go back. Let's just go to bear call search again. Here we go. Okay, and all right. I want this net. I don't want it, but let's check out Spotify here. Good 87% probability. Let's go to the profit and loss chart in that case. Okay, so what am I looking at here? Selling the 275 call on Spotify, buying the 272.50. And this is a simple 14-day out one. So let's go to the option chain for November 13th. Okay, so on my chain, what did I mention the things I'm going to look for in a bear call spread? All right, Darrell, what I do is scroll down here. I have the right probability, but the wrong. I want an 85% probability or higher in general. So that's what I have here is the probability, but this is the probability above. So 14.4 on one side is going to equal, 85.6 here. So the 272.5 at 12.6, that's that 87.4. Excuse me, folks, probability I was looking for. Okay, which will roughly equate to a delta of 0.15. That would be my starting point. Range out of the money is also important as well. 13.6%, 12%. It might be a little bit high. I usually like about 10%. But see, this delta here of 0.2 on the 265 kind of equates to an 80% probability. Not exactly, but it's close. So you could use that. And if you're going for 85% probability, you're looking at 16 or 15 delta in that case. Okay? That's what you would look for in the chain. And then you want the range out of the money that makes you comfortable. I'd say a minimum of 10% in these cases as well. So that's something that you can do on the chain to help you, Darrell, in that case. And no, the PowerOptions tools, the search tool of the portfolio right now, Darrell, is not linked directly to a broker. We used to have something called a broker link that would link to Options Express or Brokers Express. We don't currently have that set up with Thinkorswim, Interactive Brokers right now, Ally Financial, or any of the other services as well. Okay. All right. So that's just a follow-up there. I'm sorry there, follow-up from Darrell. I'll probably put that with your discussion, Darrell, which crop that in there. So that ended at 6:01 from about 5:58. Okay. And so follow-up comments here from Sam related to that ratio spread we talked about. The ratio repairs is never do a naked call or put. Can put you in trouble in a volatile market like now. I agree. I also, you know me, Sam, I'm never going to suggest doing a short straddle or short strangle with all of this EAP going on, the earnings, the election is still coming up, and the pandemic as well. Not the time for a margin call from the broker. I agree as well. I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. options do involve risk, as we have seen today, and even managing those techniques with using options for stock repairs and more also carry some risk with them as well, and they may not be suitable for all investors. Now, if you haven't tested PowerOptions, of course, we showed some great features of the search tool today, going over some of the topics with Darrell. We showed some of the features as well for some of the buried put ideas, using that percent implied volatility range where Wes might have gotten caught by mistake, and how we can use that later on to help him avoid getting into too high of a high implied volatility put option in that case. Also, we showed the portfolio tools. We showed the fantastic rollout opportunities that were available for Immediate if you're tracking covered calls, naked puts, and more. Hey, you can access all of these tools for 14 days for free. Just go to powerop.com, put in your name and email address. You'll have full use of the site for 14 days. No credit card is required. Access to the search tool in all 23 plus strategies, research and analysis, the portfolio tools for tracking, the stock repair tool we looked at today as well for Ravi. And of course, you have full access to all of the archived webinars and much more education as well. You get all that for 14 days for free. The subscription started only $45 per month following the 14-day free trial. Of course, you can cancel your subscription at any time. There's no contractual obligation for a series of X amount or Y amount of months in that case. Mention the free coaching session. Trial members or subscribers on any level of service at PowerOptions can have that coaching session as well. Again, it's a 35 to 45-minute phone conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have. Now, you can also, of course, have access to the archives. Our most popular service is the delayed service, and that's about a 15 to 20-minute delayed service. The data is updated every 15 to 20 minutes in that case here. And that's only $65 per month. But if you're doing some of those weekly spreads or managing trades often, you probably want to check out the real-time service as well. And that's $120 per month. But anytime you run a search, refresh a page, you're getting the numbers, the calculations at that very instant. All right. Other free stuff, of course, well, we didn't look at it today, but you could go to powerop.com/webinars.asp. That is a public page. You can access the webinars, and for those of you that are members, just click the free webinars tab underneath the main home tab. On YouTube, most of our presentations are posted there as well. Our Friday segments are all posted there. I'm going to crop these up for you sometime this weekend if I get a chance before Saturday. I might have one or two of these segments ready for you. They're all split up very well, actually. That first half hour I'll probably get out for William by first thing tomorrow morning. That first 30 minutes there, we talked about the ETFs and stock or portfolio insurance and more. But go to YouTube at any time. Just look up PowerOptions. All of the videos there are public. You can go through those there. You can even search on it if you want to search for bear call spreads, Darrell. You can look at the other videos we have on bear call spreads and more as well. And of course, you can check out the blog on PowerOptions or the Learning Center on powerop.com for other articles and resources as well. Well, if you do think of any other questions at any other time, remember, you can send me an email at any time to support@powerop.com or support@radioactivetrading.com as well. And of course, you can call us during market hours at 302-992-7971. Of course, trial members and subscribers, I had mentioned you can schedule those free sessions at any time.